Hello and welcome to our first and hopefully last virtual Big Fat Budget Breakfast. For authenticity purposes, I sincerely hope that either you're currently eating a full English breakfast or have just recently had one. And if you haven't done either of those, then please make sure that you go and cook yourself up one once you finish listening to our webinar. My name's Nick Haynes and I head up the tax team here at Hazelwoods. And clearly, we are all living in quite difficult times at the moment with the coronavirus pandemic. However, taxes still apply, and we have recently had a budget, and there were some announcements that came out of that you need to be aware of. First up, we have Megan, who's a senior tax manager in the Cheltenham tax team, and she's going to talk about the changes that were announced in the budget on entrepreneurs relief.
Hello everyone, I've failed at the first hurdle of trying to find the quietest room possible in which to make this recording, so please do bear with me if you hear a bit of traffic noise, but this is uncharted territory for us all. So in today's doom and gloom, I've been given the happy task of updating you on the entrepreneurs relief changes in last week's budget. The first change is to announce that it is actually no longer called Entrepreneurs Relief, and it is now called Business Asset Disposal Relief, BAD Relief, or, as I am about to call it, BAD Relief, because I'm sorry to say that the changes aren't overwhelmingly positive. It's a little bit odd in my mind that we've changed it away from Entrepreneurs Relief, as they all kept saying over at the Treasury that it was designed to be a relief for entrepreneurs, but here we are. So how does the new BAD relief or BAD relief differ from entrepreneurs relief? Well, put simply, there's less of it, 90% less to be exact. So the lifetime limit, which had previously been 10 million, has now reduced to 1 million. Some of you may remember it has been 1 million before, and we've ended up back down there. So that's a 90% reduction. I think some of us were hoping it might only be reduced to 5 million, but no, all the way down to 1 million. So some thoughts about the impact that this might have. Obviously, some people might decide that selling isn't the right thing for them to do now, but some practical ideas might be to bring in spouses. This might make having spouses involved in the business even more important than before in terms of shareholding, where you've got businesses worth in excess of 2 million, then obviously having £1 million of lifetime limit each could be really important. And just remember, if you are bringing in spouses that haven't been shareholders before, that you've got that 2-year ownership period that you'll be wanting to meet before you make a sale. Another thing to think of, and I have a live example of this at the moment, is where a spouse already has 5%, but only 5%, increasing the shareholding that spouse has can take advantage of, a larger limit overall now, whereas previously you might not have been that worried because, say, for example, the one spouse might have been getting 4 million and the other spouse, only a few 100,000. Well, now the difference would be there'd be a lot less tax to pay if you can increase the amount that second spouse is receiving. So really what we're doing there is we're playing a game of disposal limbo, trying to get as many proceeds as possible under the BAD or BAD relief bar. So now I'm moving on to talk about the transitional provisions. Now, I've actually seen quite a lot of, interestingly, and this would work better if you could see that I'm trying to do air quotations with my fingers there, interestingly worded releases that have actually given people that are currently taking part in sales a bit of false hope about what this might mean for them. So unfortunately, these transitional provisions just make BAD relief badder, not better. There is no, if you started the process before 11th of March, you're okay, get out of jail free card. Unfortunately, what happens is where you've got deals that were not completing or were started before the 11th of March and don't complete until afterwards, these provisions have the effect of dragging those sales into the new regime under £1 million of BAD relief rather than £10 million of entrepreneurs relief. And there's sort of two provisions that HMRC have got here that can catch basically the things that the tax industry were trying to do. A lot of people were worried about the changes in the budget, so people were trying to get sales in before the 11th of March. And two of the things that people were doing were using an unconditional contract and the use of share-for-share exchanges. Now, starting off with an unconditional contract, that is something that does what it says on the tin. It's a contract that at exchange is unconditional. Now, under the normal rules for capital gains tax, if you have an unconditional exchange, that is the tax point, not completion. So you might have a situation where, under the usual rules, you exchange in one tax year and complete in the other. Well, it will be taxed in that earlier tax year where that exchange is an unconditional contract. So where you had sales that were quite of the way, way down the road, there were people introducing these unconditional contracts to exchange prior to budget day in the hope of utilising their entrepreneurs relief. Now, this new provision it basically includes the requirement for the taxpayer that's claiming the entrepreneur's relief to make a declaration that they did not exchange for the purposes of using this unconditional contract rule. And unlike most tax laws where you have to state that one of the main purposes is not the avoidance of tax, here you have to say that no purpose was the use of this unconditional exchange provision. Now, that is a very high test, and if you have, any kind of conversations, file notes, emails, where people are discussing, come on guys, let's get this unconditional exchange sorted before the budget date, then those clients are not going to be able to make that declaration, and the new £1 million limit will apply. The other thing that I mentioned very briefly there are share-for-share exchanges. Now, this was a little bit aggressive anyway, but this is where people were utilising the rules in the tax legislation where normally if you exchange securities for another security, so put a parent company on top of your existing trading company and exchange your shares in exchange for new shares, then the usual rules are that those new shares stand in the shoes of the old ones. But there is a provision under Section 169Q of the Taxation of Capital Gains Act where you can elect for that not to apply and pay entrepreneurs relief. So this would be a way that by putting a top company on top of your current trading company, you can crystallise that capital gains tax at entrepreneurs relief prior to any eventual sale. So that was one way that people were trying to get the tax point in earlier ahead of budget day. That has actually been prevented for any share-for-share exchanges since the 6th of April 2019. So quite retrospective there. There will be exemptions where you've got genuine changes of control, things like that. So do get in touch if you think that this might have caught something that it wasn't intending to catch, because there are some exemptions. But put simply, if you have a share-for-share since the 6th of April 2019, then any election under that provision, Section 169Q, is only effective on the date that the election was made, not the date of the share-for-share exchange. So that brings me to the end of my very happy Entrepreneurs Relief news. Thank you very much for listening.
Thanks, Megan. I think we all realised that there was going to be significant changes to the Entrepreneurs Relief rules. but we didn't realise quite how bad things were going to get. It's clear that the government and HMRC are being quite clever by introducing the anti-forestalling rules, particularly for a number of schemes that were being touted around by firms of accountants prior to the budget on the share-for-share exchange point. However, I tried telling that to my client, who I had to call shortly after the budget, who fell foul of the unconditional exchange point that was going to cost him and his fellow shareholders about £2.5 million extra tax.
Recorded.
Next up, we have Nicholas, who's a tax partner in our Staverton office, who's going to cover the changes that are being brought in from the 6th of April on capital gains tax reporting for residential properties, and also to cover a couple of items that were brought up in the budget that affect pensions and top slicing relief.
Good morning. For those of you that don't know me, my name is Nicholas Smale. I'm a partner in the tax team here at Hazelwoods. I'm going to start by talking about a number of changes to the capital gains tax rules that have been previously announced but are coming into effect from the 6th of April 2020. The first change is the shortening of the final period of ownership when calculating the period of occupation for principal private residence relief purposes. Currently, the final 18 months of ownership count as occupied, but this will be reducing to 9 months. This will increase the tax if there is a delay in selling the house or the house has previously been a main residence but is no longer occupied as such. Many of you will probably remember the furore caused by politicians making elections and moving them from one property to another, and this reduction will reduce the attractiveness of this. The second change is the effective abolition of lettings relief. Going forward, the relief will only be available if you occupy the property at the same time as the tenant. As a result of this, there could be an additional £22,000 of tax payable for a property jointly owned by husband and wife. The third and most important change applies to the disposal of residential property, where the exchange takes place after the 5th of April 2020. For these sales, it will be necessary to submit a return to HMRC and pay any tax on the gain within 30 days of completion. A return will not be required for no gain, no loss transfers, for example, between husband and wife, or where there is no tax. Principal private residence relief is available when calculating the gain, but care will be needed if the property has not been the main residence throughout the period of ownership, as it may be that part of the gain is taxable. The gain will need to be calculated based on the facts available at the time. If the gain is early in the tax year, the taxpayer will have to estimate their income for the year to decide the appropriate capital gains tax rate. It will only be possible to offset brought forward capital losses and those incurred during the tax year up to the date of sale. Any capital losses incurred later in the tax year will have to be offset when the tax return is completed at the end of the year. HMRC are developing a new reporting system, and it appears that clients will need to register with HMRC, and only when that is done can they authorise agents such as ourselves to act on behalf of them. Given our previous experiences with HMRC systems, it is likely that this could take more than the 30 days needed to submit the return, so planning will be essential. When completing the forms, reasonable estimates are allowed where actual figures are not known, but the reports are subject to penalties and inquiries in the same way as other returns. It will therefore be important that they are submitted on time and as accurately as possible. For taxpayers within self-assessment, the gain will also need to be included on their end-of-year tax return and the final tax position calculated. It will then be possible to reclaim any overpaid tax, for instance, because of later losses. It will possibly therefore be beneficial for clients to get their tax return done early. Any of you here today who are aware of clients thinking of selling residential property need to make them aware of these changes and encourage them to speak to their accountant as soon as possible. As well as starting to register with HMRC, they will need to start collating all the information needed to calculate the gain. If valuations are needed, this may take time, and they will need to get on with commissioning them. Turning to the budget, we were expecting changes to inheritance tax, but nothing was included, so perhaps they're being saved for another day. There were, however, a couple of other points to pick up on. The first relates to pensions. Every individual has an annual allowance of £40,000 that they can put into a pension, provided they have the relevant earnings. From April 2016, the annual allowance was restricted for high earners. The restriction applies when adjusted income, which is broadly total income plus all pension contributions, exceeds £150,000, and threshold income, which is broadly total income less pension contributions, exceeds £110,000. Once both these thresholds are exceeded, then for every £2 of income over £150,000, the annual allowance is restricted by £1. The result of this is that for someone earning £210,000 or more, the annual allowance is limited to £10,000. From 6th of April 2020, when adjusted income exceeds £240,000 and threshold income exceeds £200,000, the tapering for the annual allowance will apply. The lower limit is now £4,000, which will hit those earning more than £312,000. If someone has unused annual allowance in the previous 3 tax years, this can also be carried forward and used to top up the annual allowance in the current year, with the earliest year being used first. The calculation of the allowances can be complex, and advice should be taken. Hazelwood Financial Planning can help with this to ensure that the correct contributions are made. The second change relates to the calculation of top slicing relief on the surrender of a bond. Top slicing relief aims to ensure that the tax paid on surrender is no more than would have been the case if the gain had been taxed evenly over the life of the bond. If a taxpayer's non-bond income would be taxed at the basic rate, but when the gain is added, it takes their income over £100,000, the personal allowance is lost. When calculating top slicing relief, it is necessary to look at the other income plus the sliced gain, which is the total gain divided by the number of years over which it has arisen. HMRC tried to deny the availability of the personal allowance when calculating the tax due on the sliced gain, but lost at the first tier tribunal. These changes have been introduced to legislate the outcome of the decision in the tribunal. As an example, for a taxpayer with other income of £40,000 and a £90,000 gain that has arisen over 10 years, the saving as a result of top slicing relief is £18,000. As a result of this case, it may be possible for affected taxpayers to make a claim for a repayment of tax for the 2015-16 tax year onwards. Any claim in relation to 2015-16 would need to be made by the 5th of April 2020.
Thanks, Nicholas. The deadline now for submitting the capital gains tax returns for residential properties at 30 days is going to be really tight in terms of collating all the necessary information to be able to prepare the calculations and to submit them in time. Added to that, the admin burden of having to register for a separate type of tax reporting is clearly going to put a lot of strain on the ability for us to turn calculations around and submit within that 30 days. So I'd ask all solicitors who are listening to this presentation to make their clients aware of the new reporting requirements, and of course feel free to pass them in our direction. On the pensions changes, the government is continuing to affect the ability of people to save for their retirement. And what seems to be happening is we're getting to a point where no tax relief is going to be given on day one. But the flip side of that is that the government won't be receiving any tax from the pension drawdowns in the future. But I guess that's not going to be Boris's or Rishi's problem. On the top slicing changes, obviously a very technical area, and I'm not expecting any of you to really understand the impact of the changes. I'm not entirely sure I understand them myself. But of course, if you're aware of any individuals with these types of bonds, then do feel free to pass them in Nicholas's direction. Next up, we have Katie Williams, who's the tax director in our Cheltenham tax team, and she's going to cover off some employment taxes issues.
Hello, and thank you for joining us today. My name is Katie Williams, and I am an employment taxes and personal tax specialist at Hazelwoods. I was going to spend my allocated slot this morning talking you through the changes to the off-payroll working rules, often referred to as IR35, as this has been big news for contractors and businesses who use contractors for the last few months. However, on Tuesday evening, the Chief Secretary to the Treasury, Steve Barclay, announced that they will be postponing the introduction of these rules until the 6th of April 2021. This announcement comes just 1 week after the reforms were confirmed as part of the Budget 2020 and forms one of several measures to help businesses following the coronavirus outbreak. It is, however, only a postponement, and I will be back talking about all of this later in the year, helping businesses to understand their obligations in more detail, and hopefully at that time with the breakfast we promised you. But in the meantime, I hope that this delay will give businesses across the UK a little bit of breathing space from dealing with all of this to enable them to focus on other areas of their business at this difficult time. So, what else can I talk to you about this morning? Well, I won't keep you long, I promise, but there are a few useful topics which might be prudent to mention today. Tax payments. Now, all businesses have them in one way, shape or form. Over the next few months, we cannot hide from the fact that a lot of businesses will struggle to make them. The government are announcing new measures and help packages on a daily basis. We are collating these on a dedicated webpage, so do please keep checking our website for the updates. But one of the measures already announced is a helpline to support businesses who are worried about their ability to pay and to enable them to set up time to pay arrangements. A time to pay arrangement is used to prevent the accumulation of additional penalties when an individual or a business cannot make their full tax payment on time. Usually, HMRC go through a detailed list of questions to determine a taxpayer's ability to settle that liability. But given the current climate, I suspect that they might have relaxed their criteria just a little. We can but hope. Agents aren't usually permitted to set these up on behalf of clients, so if you or one of your clients thinks that they will struggle to meet their tax liabilities, we would encourage communication with HMRC. Please don't just ignore it, hoping that it will go away. Prevent those penalties arising on top of the liability by sorting it out. HMRC have dedicated 2,000 helpline staff to deal with this. I think that might, however, mean that there are a few areas where they might be short-staffed elsewhere, but still, we do implore people to tackle it head-on and make that call. Details will be on our website, but also on hmrc.gov.uk. Now, on to a slightly difficult topic, but sadly one which I fear may become an issue for a number of businesses, and that's redundancy. We've already seen that a number of our well-loved high street stores have closed on the prom in recent months, and that was before the current difficulties. Indeed, the lovely Flynn's Bar and Brasserie in Montpellier Courtyard, I saw announced just this week that they will be closing their doors for good after 21 years. Staff across the UK will be made redundant in times like these. There is sadly no escaping that. Redundancy payments are quite straightforward, according to most. Nearly everyone is aware of the £30,000 tax-free exemption. However, people aren't always aware of the intricacies of it. I mean, the general awareness is that as long as the payment is compensatory, then it is okay to pay it tax-free. Well, that's not strictly the case. You should look at the contractual position. What does it actually say about notice periods in the contract? And also, what is customary for your business? This can be one which often catches employers out. If you have made employees redundant before and are usually quite a generous soul with the severance package, if it is known within the business that you usually might get an extra month or maybe two's worth of salary, that becomes an expectation amongst your employees, even though you're just doing it out of the goodness of your heart and is not actually due to any contractual obligations. This then becomes a customary pile-on and is subject to tax and national insurance as though it was salary. I've seen a lot of instances where businesses simply pay £30,000 to former employees on the assumption that there were no additional tax consequences. They seem to be unaware that any holiday pay, accrued overtime, and since April 2018, all pylons, that's payments in lieu of notice, contractual or otherwise, are subject to income tax and NIC charges as though they were salary payments. This shouldn't be new information, but we find that it often is. And from 6th of April 2020, there are more changes. HMRC are introducing ways into which the redundancy payments are treated with regards to employers' national insurance. Whilst employers seem comfortable with a £30,000 limit, payments above that are deemed to be relatively tax efficient at the moment for businesses due to the national insurance position. Currently, there are no secondary, that's employers' national insurance liabilities, arising on any payments in excess of that £30,000 exemption. However, from April, the new regulations require that a Class 1A charge will be payable on termination payments. For those of you that are still awake and those of you that might be in the know about this, Class 1A is actually a tax charge on benefits in kind and is payable in July following the end of the tax year. But on these termination payments, Class 1A national insurance will be payable in real time on termination awards in the form of cash. There aren't any transitional provisions for these termination awards, so Class 1A will only be payable on termination payments received on or after the 6th of April 2020. Now, we hope this doesn't mean that there will be terminations en masse on the 5th of April, but as everything is changing so very quickly at the moment, who knows? It is certainly something to consider, though, if your business or your client's business is going through a reconstruction and staff consolidation in the near future. Finally, as a main topic, I wanted to mention company cars, particularly the green ones. That's the environmentally friendly version and not the colour. From the 6th of April, those of you with a zero-emission company car will see your benefit in kind tax charge drop from 16% of the list price down to nothing. It will creep up slightly from 1% in 21-22 and 2% in 22-23, but I think you agree that this is still a welcome move with a planned phasing out of diesel vehicles ahead. So if you are thinking of changing your vehicle in the not too distant future, and there might be some cracking deals to be had in the short term, please do have a chat with us first. Company cars can be an expensive benefit, the costs of which can outweigh the benefits to your employees, so choosing wisely is imperative. Have a chat with us at first if you are unsure about the tax consequences of your preferred vehicle. Now, there are a few other employment-related topics which are new or announced in the budget, which I thought I'd briefly mention. Employment allowance, that's going up from 3,000 to 4,000, but is only available now for smaller businesses whose secondary Class 1 NIC liability is less than 100,000, and it is operated as a de minimis state aid application, so have a look out for that. National insurance tax breaks for employers engaging veterans for the first 12 months of their employment. That's not for all your employees, unfortunately, that's just for the veterans. Statutory parental bereavement leave is now available for 2 weeks for anyone who's sadly affected by such circumstances. Finally, changes to the way in which holiday pay is calculated is one to look out for. That's moving from a 12-week review period to a 52-week period to try and ensure that there's a fair calculation for all of those who are on variable hours across the year. As you can see, there are a great number of topics affecting employers and employment taxes at present. So if you do have any questions or you need any assistance, please don't hesitate to get in touch. Employees are usually an employer's greatest asset, and so it is really important to get these things right. Thank you very much for your time.
Thanks, Katie. Obviously, in these difficult times, redundancies are going to be an inevitability. It was reassuring with the announcement that was made on Friday the 20th of March about furlough leave and the government covering 80% of the costs up to £2,500 per month. And it's hoped that that measure will make businesses pause in terms of making those drastic decisions about redundancies. The deferral of the off-payroll working rules by a year is obviously incredibly welcome, but all those businesses that are affected still need to be reviewing their contracts because, again, there's an inevitability that these rules will be brought in. So it would be good to get all the reviews done early. Next, we have Gemma, who's an Associate Director in our Staverton office, who's going to cover off some changes to innovation taxes.
Hi, my name is Gemma Vaughan and I'm a Corporate Tax Associate Director. I specialise in innovation tax reliefs, namely Research and Development Corporation Tax Relief and Patent Box Corporation Tax Relief. The 2020 budget highlighted a few minor changes to the R&D scheme as follows. Firstly, the rate of the R&D expenditure credit has changed. This is the R&D incentive that applies to large companies and to small and medium-sized companies which undertake projects on a subcontract basis for large companies or have received grant funding. The credit has increased from 12% to 13% with effect from 1st of April 2020. This effectively means that for every £1 spent on qualifying development costs, the company can receive a credit of 10.53p, up from 9.72p. This credit is either offset against the company's tax bill or is paid in cash if the company has no tax liability. Whilst this is not an enormous increase, it is a step in the right direction towards the tax savings appreciated by smaller companies of 24.7p for every £1 spent. The second change highlighted in the budget is to delay the introduction of the restriction to small and medium-sized companies surrendering for R&D tax credit, where it was proposed to apply a cap on the credit by reference to the PAYE and NIC paid. The original proposal was to take effect from the 1st of April 2020 and was designed to restrict the amount of losses that could be surrendered to a maximum of 3 times the PAYE and NIC costs incurred by the company. This will now be delayed until 1st of April 2021. However, the government will also undertake further consultation as the original proposal has been considered harsh for certain genuine claimants. For example, start-up companies where the main developers are the directors themselves who may not be paying themselves a salary and therefore not incurring any PAYE costs, or where the R&D activity is outsourced to a third party. The third proposal by the government is to undertake a consultation on the enhanced eligibility of further costs for R&D tax credits. It is proposed to include cloud computing costs and data within the scheme. Currently, these are not an eligible head of expenditure as they are considered a higher cost rather than a consumable. Hopefully, this will bring the regime up to date for some of the more typical expenditure incurred nowadays by IT and software companies undertaking development work. In addition, although it has not been mentioned in the budget, the government is currently considering changes to the legislation to marry up the new intermediary rules regarding off-payrolling and the treatment of externally provided workers for R&D tax relief. Although we do not know what these changes will look like, we will be keeping a close eye on this to determine the effect for companies using external workers. With regards to Patent Box, the budget did not bring about any new changes. Essentially, the Patent Box is a corporation tax deduction against taxable profits, which effectively results in a 10% tax rate being applied to profits attributable to profits derived from patents, which almost halves the corporation tax rate currently payable by companies. Following Brexit, there was a possibility that upon exit from the EU, the government would look to revert back to the rules pre-1st of July 2016, which are more straightforward. However, at present, there are no plans to do so. The changes that were introduced from July 2016 apply to new entrants to the Patent Box regime or for new core IP generating income for existing Patent Box companies. Those already within the scheme with no changes to their core IP were able to continue using the original method of calculation under the grandfathering provisions. However, from 1st of July 2021, all companies that were under the grandfathering provisions will be required to calculate their Patent Box profits under the new streaming method, which then also applies a restriction if there is any bad R&D. Bad R&D is essentially any connected party subcontractor costs incurred during the development of the product or process for which the intellectual property covers, or the cost of acquiring a patent or an exclusive license to a patent. To give a practical example, we have recently assisted a client who was looking to restructure their group. They wanted to transfer trade and assets of a subsidiary up to a parent company. However, the company holding the trade and assets had elected into the Patent Box. On a trade and assets hive-up, the Patent Box regime follows the patents to the new company and can continue under the existing rules. However, the parent company needed to sell products incorporating the patented technology prior to the rest of the trade and assets being hived up, i.e. they wanted to undertake the transfer in 2 stages rather than in one go. However, to undertake it as 2 transactions would then result in an acquisition of a new right in the parent company. This would mean a restriction to the patent box profits on the patents being transferred, as well as bringing the whole patent box regime for the parent company into the new rules a couple of years early. We did find a solution for the company, but if the transfer had taken place without this appropriate planning, there would have been more tax to pay. If you have any concerns or queries regarding how a structure of a group may affect the eligibility for R&D or patent box, or would like to know more about either of these schemes, please do not hesitate to get in touch. Thank you.
Thanks, Gemma. Clearly, the R&D tax relief is going to be useful for those companies that are able to claim a repayment, as it will aid their cash flow in times of uncertainty with the coronavirus pandemic. Therefore, some clients may well be looking to bring forward their claims to provide them with that extra cash flow. Finally, as is traditional, we have VAT, and we have Russell, who is a senior tax manager in our VAT team, to cover off some changes in the budget and some other VAT issues that you should be aware of.
Russell Flagg, VAT. On the face of it, from a VAT perspective, the budget wasn't particularly exciting, with no major wide impacting changes. We had the announcement that women's sanitary products were to become zero rated from the 1st of January 2021, followed by the announcement that e-publications or e-books were also to become zero rated from the 1st of December 2020. With e-publications, there has always been a disparity between the purchase of a physical book, which is zero rated, and an e-book, which is currently standard rated. This change will see an alignment of the VAT rules for a physical product of the book and its e-publication version. These may not appear to be huge announcements in the world of VAT, but actually this was a pretty big moment for the tax. You will notice the difference in the dates for these changes. The change to digital publications is prior to our transitional arrangements with the EU ending, whilst the change to the VAT liability of women's sanitary products is 2021. This is significant, as the government can already make changes before the Brexit transition period ends to treat e-publications the same as their physical counterparts, as this has been allowed for all member states by the EU since 2018. But the UK making its own additions to the zero-rated group is more complex. If we look at a brief history of VAT, it was introduced in 1973 as part of the UK joining the EEC, and it replaced the purchase tax. The government had always promised that key essential items would not be subject to VAT, such as books, utility bills and food. The EEC was not keen on countries having these zero-rated provisions, but did agree to allow some items, including books, utilities and nearly all food, to be zero-rated. But there was one condition which the UK would have to adhere to. No new items could be added to the zero-rated group, and there haven't been. In the early 90s, utility bills were removed from the zero-rated group by the government, and this has therefore meant these could not rejoin that group. Today we have three rates of VAT, the standard rate at 20%, the reduced rate at 5%, and the zero rate. Supplies which fall within the zero and reduced rate are defined in legislation, and our change in eating habits in particular have led to numerous tribunal cases to decide whether items fall within the definitions. The most famous example is probably whether a Jaffa cake is a cake or a chocolate-covered biscuit. So there are interesting times ahead now that the UK is no longer restricted to the EU VAT framework, and we could see more items changing VAT liability in the future. For now, though, we just see these changes to women's sanitary products and e-publications. Also in the budget, the Chancellor reconfirmed that VAT postponed accounting will be available to importers at the end of the Brexit transition period. Currently, where a business brings goods into the UK from non-EU countries, it is generally required to pay import VAT at the time the goods arrive in the UK, before subsequently reclaiming this from HMRC as input tax on its VAT return. but only once it has received the C79 certificate from customs. This meant a delay between paying the VAT at import and being able to reclaim it back on the VAT return. At the end of the transition period, the UK will leave the EU VAT regime, meaning imports from the EU would become subject to 20% UK import VAT for the first time. This VAT would be due for payment before the goods were permitted to clear UK customs. However, postponed accounting for import VAT will allow businesses bringing goods into the UK from both EU and non-EU countries to account for any import VAT due on their VAT return, thereby potentially providing a significant cash flow benefit. Importers should record the postponed accounting for VAT on their VAT return by increasing the output tax in box 1. That VAT can then be claimed as input tax in box 4, subject to the normal rules, including any partial exemption restrictions. This will be welcome news from any business which brings goods into the UK from either Europe or the rest of the world. That concludes the VAT roundup from the recent budget. I've been Russell Flagg and part of the VAT team at Hazelwoods.
Thanks, Russell. VAT is certainly going to be something to watch with the transition out of the EU and the flexibility that might offer to the government to make changes in the future. That's the end of our presentations. Thank you for listening. I sincerely hope that we will meet each other again very soon and we can all sit down in a mass gathering and have a proper breakfast when we can then update you on latest tax issues. In the meantime, please do stay safe and well, and now go and make yourself that full English. Thanks very much.